He is the managing director and a principal of Seawood Management in Boston. John received his BS in Business Administration from Boston University and a Master's of Science in Finance from Boston College. He began his career in 1984 as a leasing analyst for Compugraphic Corporation. In 1988, he joined the Boston 5-cent Savings Bank as a financial analyst, and then from 1989 to 97, he worked for Fidelity Investments. And at Fidelity, he was responsible for retirement counseling and Fidelity's tax-exempt services company, providing retirement plan investment services to the not-for-profit community. He then became Senior Vice President at UAM Investment Services, and finally, he joined Seawood Management in the year 2000 and is now a Managing Director and owner, along with Tom Woodhouse, who will be our keynote speaker later. So I'm delighted to welcome John Bracci. Hope you will too.
Thanks, Ruth, and nice to see all of you. Some of you I may have had the pleasure of chatting with back in a snowy evening back in January when Tom and I were here going through a few investment fundamental workshops. And it's a special treat for me. I lived here in Winchester for 15 years. As I came in this morning, I drove by the old place. This town has changed a lot since I was here 7 or 8 years ago. So when I was here last time, we went through investment basics, we went through asset allocation, and talked about how to invest money. And one of my slides at the end was a slide that illustrated a little bit about where to go for professional help. What's the difference between different kinds of investment advisors? What products do they sell? How much does all that wisdom cost? And it generated a lot of questions and interest. So Ruth asked if I would come back to this workshop here today and take this framework and expand it a little bit more. So happy to do so. I want to cover a lot of ground here in the next 20, 25 minutes to kind of give you a lay of the land. Financial advisors is a pretty broad topic. Anybody can call themselves a financial advisors. There's 20,000 of them listed in New England under various sources. So let's sort out what those financial advisors are. What products and services do they offer? What products are they trying to sell you? How much is all this great wisdom going to cost you? And do I need one? And we'll leave time for lots of questions and answers at the end. So let's just jump into it. Thank you. For the purposes of our conversation here today, I've segmented financial advising between what I call financial planning, along with investment management. They're two different animals. There's many firms out there that provide just financial planning. I'll talk about them later. There are many that just provide investment management, and there are some firms that do both. There are hybrids of both. So you know what the financial planning issues are today. We heard John Sullivan talk about many of the estate planning issues this morning. I would echo everything he said and then some, and I'll talk about that more in a minute. Financial planning, the core of financial planning is what are your assets? You heard John this morning say, do you know what they are and where they are? And does your spouse? Also, how much are you spending? What's your spend rate? What's your spend rate as a percentage of your assets? What other assets do you have? What's your house worth? What are you going to do with your house in retirement? What are you going to live in? Are you going to downsize into what? What's the net proceeds of that sale? And how are you going to spend those assets down in your retirement? And how much of those assets do you hope to send to your children, to charities, or to other designations? So that's what I call the heart of financial planning is. Clearly, too, there's a part of insurance that's appropriate to make sure you protect your assets, to understand other liabilities you may have. All of that, to me, is the financial planning arm. The second arm is the investment management. Clearly, you can have all these great plans. Number one, you better execute your plans. How many times have I seen great, glossy financial plans that actually have the right answer, if there is such a thing, and sit on a shelf, never to be used? But assuming we execute our financial plan, there's a whole other arm of how do you manage those assets over time, that I'll talk about, and what are the different players that would be happy to manage those assets for you. So let's start start with the first question. Do I need a financial plan? Maybe you don't. I grew up, I'm one of 7 kids. I grew up watching my dad save money and put money aside, put all of us through college, private colleges. That's where I learned about financial planning. That's where I learned about spending below your means, not over your means. And that's where I learned about keeping track of what it is what you're spending. So I had a pretty good education. My dad was a classic do-it-yourselfer. He was an engineer. They didn't have spreadsheets back then. We had lots of papers keeping track of all this kind of stuff. But then when I'd sit down and go through his investments with him, he never found a mutual fund that he didn't like. He had many mutual funds, probably more duplication than diversification. But there's nothing that says you can't do it yourself. Now, how many of you think, John, you're an investment advisor, you make a living out of managing money and providing investment counseling. How many of you think that I'm going to suggest to you that you need a financial advisor? Probably all of you. But my question to you, you answer the question whether you need a financial advisor or not. Do you have a plan? Do you have a will? Have you looked at that will yourself? Have you had a lawyer look at that will in the last 5 years? Do you know how much you spend? I bet you don't. I've been through spending exercises countless times. I bet 90% of people can't tell me within $10,000 what really goes through their checkbook and through their credit cards every year. So do you know how much you spend? Do you know what percentage of your assets are being spent down in your retirement? Do you have reserve cash to meet your spending over the next couple of years? How are your investments allocated? Do you know your allocation? Why is your money allocated that way? Do you have diversification or duplication like my dad? What are the fees that you pay to invest all this money? And how are those assets performing? Let's talk about other assets. Do you have real estate? You're trying to downsize. Are you going to join a senior community or going into assisted living? What is that going to cost you? Do you have the money to cover that? Do you have an estate plan? Are you going to give the money to kids, to charity? Do they know that? Maybe you want to give some of that money to them now so they can buy a house when they can really use it, as opposed to waiting how many years until your estate's settled. If you have answers to all these questions, you have a plan. Congratulations, you don't need a financial planner. My other question is, are you sticking with your plan? How many times do I hear people that say, yeah, we spend X, and then look at it next time, and well, we spent 2X or 3X. Or I have an asset allocation that makes sense to meet my spending needs and my financial situation, but we go through the market volatility that we've all experienced in the last couple of years, and all of a sudden that plan shifts and they move the money around, and they're not sticking with their plan. And importantly, does my spouse know about the plan? Many times, historically, it's been one person, one spouse is the CFO, the Chief Financial Officer, and the other spouse kind of checks out and doesn't really know what's happening in the plan. That's a problem. Your spouse needs to know what's going on in the plan. I've been preaching this all my life. I was reminded of this last month when the state lawyer called me and asked me to meet with a recently widowed woman in his office. Those are the hard meetings, right, in our business, but frankly, it's a privilege to do that. The widow obviously had issues. She just lost her husband, and she was also anxious that she didn't think she had enough money to live in retirement. So we dropped what we were doing, got out pencils and papers and calculators, pulled together her assets, on the fly, went through her expenses, and kind of came up with a quick and dirty analysis that said, yeah, you're okay. Went back and further analyzed that to demonstrate that that was a true assessment. Well, what needless anxiety for this person who's already lost their spouse to not have an understanding of what's going on in the financial plan. P.S. According to a study I saw recently, only 45% of you have a will. Even if that number is only half right, a quarter of you don't have a will, you need to have a will, period. And one that's been looked at in the last 3 or 4 years. I talked about sticking with a plan. Do the average investors in retail mutual funds stick with the plan, or do they try to move in and out of different asset classes over time? The answer is they move in and out of asset classes over time. I pulled this together using retail mutual fund flows. This goes back, shows the S&P 500, going back since 1996. And these numbers show the amount of money going into stocks and out of stocks over that time. You can't read this chart in your blue folder. I have a copy of all my slides here that you can refer to and see the numbers. But the visual works. During the good old days when all you had to do was buy tech stocks and the money went up, you can see right at the height of the market in the year 2000, 300 billion went into stocks and 50 billion came out of bonds, just at the top. All that hot money went in chasing stocks just as the market fell. Market fell, all the money's coming out of stocks, going into bonds just as the market was ready to take off. Same story in 2007. Then we had the meltdown through 2008, 2009. And we had in 2009, only 11 billion went into stocks, 375 billion went into bonds, just as the market recovered about 80% at the time. This is not what I call sticking with the plan. It has a good flavor of market timing. If you think you can market time, I challenge you to show that you can do it consistently over time. And the cost of doing market timing and doing it incorrectly is extremely material. Here's a chart you've probably seen these before, the impact of being out of the market when the market runs. I found this on Vanguard here recently. So what this shows is, going back, this was through 2005, if you had been in the S&P 500 for 15 years, your total return was 11.5% annualized, 11.5% a year. Here's what's fascinating. If you were Mr. or Mrs. Market Timer and you were out of the market because you knew when the market was going to go down, and you missed just the best 10 days, not 10 weeks, not 10 months, just 10 days, out of 15 years. What's the big deal? Your return was only 8% annualized. That's about a 3.5% difference per year over 15 years. You have 50% less money, and you were only out of the market for 10 days. If you think you can time that successfully over time, I would challenge you to say the cost of being wrong is material. Stick with the plan. So, one of them may be good, offset by a couple bad ones, and you have an expensive index fund. That's not advice. That's not portfolio management. That's duplication. You can do that yourself. Go buy a couple Vanguard index funds and call it a day. What's in between, by the way, when I said I would do this presentation, I asked Ruth if I could be controversial and opinionated, and she said yes. So that's what you're stuck with. So what's in the middle are those advisors that do both. Understand a financial plan, are happy to manage your money. Frankly, that's how they can afford to do the financial planning. And those companies come in many different flavors. Registered investment advisors, that's what C-word is, are often standalone advisors, or sometimes they're tied to a broker-dealer. You need to understand the difference, and I'll explain why. Or your full-service brokers, the JP Morgans, UBS, Merrill Lynch's of the world. Now let's look at what some of the products are, and some of the services, and what some of the fees are of these different categories. Yeah, it's too slow, Tom. Can we can I just pause you there? Mine is not pushing it hard enough. Okay. Products and what you get from the financial planners and estate planners are pretty self-evident. The fees for those services can be all over the board. A typical kind of one-time financial plan from a typical fee-only advisor could be circa $1,500, could be $3,000 or $4,000. Obviously, a function of how much time, energy, and complexity is required by the financial planner. I've seen with the high-end advisors, the JP Morgans of the world charging $10,000 to $20,000 for a very high-end, multi-generational plan that it talks about, stock ownership in a company, et cetera. So it's a pretty big, wide range, but a kind of classic financial plan for many of us, where we're just wanting to look at our assets and liabilities and kind of look at our asset allocation, can be circa a couple $1,000s, just to give you a kind of a starting point. So I went through it. I went to a couple of financial advisor workshops. I went to cfp.net, and they list financial advisors in your neighborhood. I went through a bunch of different websites. They're all kind of interesting. After a while, you kind of get a feel for what the different advisors look for or look like. And I went to see, we have 12 different folks in our firm. I see the value of having a couple of different folks in the shop. So I went and looked at advisors. I had 3 or 4 advisors and had young guys and old guys. Somebody asked the question this morning, what are my advisors, 80 years old? Do I want to think about a younger guy? I would argue yes. And all of them say, hey, bring all your money together. Bring all your assets together. That's all we're going to talk about this morning. Putting together a balance sheet to show what your assets are, what your income is, what your expenses are. Well, that makes sense. A lot of them have the questionnaires, too, they want you to fill out. What kind of an investor are you? And I clipped this one. I thought I'd share it with you just to be controversial. Here's one that the advisor that wanted me to do a risk tolerance quiz to understand what kind of investor I am. And here's some of the words they used. Are you flustered by month-to-month fluctuations? Are you intimidated by the idea of researching your investments. Do you fret about choosing the right investments? What is this? What kind of, this reminds me of the olden days in the mudslinging with politicians where they'd say, hey, Congressman, is it true that you stopped beating your wife? How do you ask for that? Yes, it's true, I no longer beat my wife. Or or no, it's not true, I still beat my wife. How do I answer a question? Do you fret about choosing investments? I pick stocks for a living. I was going through Bank of America's financials yesterday. I fret about understanding Bank of America's financials, understanding how they reserve for loan losses. If anyone understands investments, they do fret. That doesn't mean I don't own them. And this whole attitude, oh, when I sell my investments, if they went down 5%, 20% a year, if I knew the answer to that, why would I need you as an advisor? Be careful of the paint by the number advisors who want to put you in a box, score it out, and kick you into some bucket as if you're like every other investor. You're different. We use these. I built spreadsheets like this and financial software like this back in the early 90s for our retirement counselors as they ran around the country. Why? Because they didn't know what they were doing, and we didn't want them to drift off the farm. If you keep them on the farm by letting them score questionnaires, they're not going to blow up a client. But that's not financial advice. Where's my soapbox? The other thing that really bugs me about this risk tolerance is this attitude of many of the peers in my industry that talk to people in a very patronizing manner. Oh, are you nervous about the market? Oh, I don't want you to feel nervous. I want you to be able to sleep at night. So let's put you in something very conservative. What does that mean? If I walk into the doctor's office and he says, John, I'm sorry you have cancer, I want you to start chemo. Oh, chemo, I don't want chemo. I'll feel awful and my hair will fall out. Maybe it already has. And the doctor says, oh, don't feel bad, John. Just take 2 aspirin and call me in the morning. You call that malpractice. And if an advisor is telling you, oh, I don't want you to feel bad about how you invest, and I want you to feel like you can't take any volatility, let's put you in some very conservative investments. How are you going to feel when you're sitting in all bonds and 15 years from now your purchasing power isn't worth spit? How are you going to feel when you've got all your money in a CD earning 1% and your cost of living is growing at 3% and you can't make ends meet in 10 years? How are you going to feel? Don't tell me how I feel. Tell me what makes sense from an investment management point of view, long term. I'm off my soapbox. Beware of the paint by the number investors. Here's another one that this brochure came to my house last week. I really enjoyed it. 18 pages of all this investment advice and how to retire in style and be comfortable and happy, and had a picture of the boogeyman on the front cover, which is again more that doom and gloom selling that always amuses me. And these folks, these are professional meeting goers. Their whole marketing shtick is, we want you to come and meet with us like every other day. And some of those advisors, I guess, only meet with you once a year. Well, hold that thought. Once I build up an investment plan and have a client that's up and running, I'll meet with them more often in the first couple of years. Clients that have been with me a decade or longer, once a year is plenty fine. They'll thank you. We'll talk often. We'll send them notes along the way, tell them what I'm doing. But I don't need to meet with them like these guys do. They want to meet every 90 days. Are you kidding me? Do I want to meet with somebody who wants to meet with me every 90 days? And to set up the meeting, to set up my whole program, I get to go through the retirement meeting, the design, the roadmap meeting, the review meeting, the implementation meeting, the recap. Holy smokes. These are professional meeting goer. Do you think that the person with the experience in this firm is coming to all those meetings? I don't think so. By the way, I was really amused. Then at the bottom, after they give you all this great wealth of information in their whole newsletter, they had this full disclaimer that says, by the way, we're not responsible for any actions you take without proper legal advice. I'm not sure they're buying their own marketing material. I was amused by that. So that's not to say that gathering money isn't important, and gathering up information, understanding clients' situation is important. I spend a lot of time with my clients understanding what their income needs are, how much they're spending, and where's that money going to come from? Here's my financial plan for you, one easy step. Do you know what your spending rate is as a percent of your assets under, investable assets? If you don't, you need to. And you don't need a financial planner to do it. Here's your homework tonight. You and your spouse sit down with each a piece of paper tonight at dinner and write down what you spend your money on during the year and compare notes. You'll be, my hunch is, miles apart, but you can help each other figure out and remember all the different expenses that go through your household and come up with a number. If you want to be prompted for some expenses, Kiplinger runs a great website. It's one of my favorite websites. they have a section called Tools and Budgets. Nice little spreadsheet that will show you all the different assets, or excuse me, all the different expenses to help you, add in all those expenses. I don't care what you spend on postage stamps. Stick with the big dollar stuff to get a sense of what your spending is. This is the most important financial planning any advisor can help you. Because if you are out here spending 7 or 8% of your assets, I don't care how you're allocated. You're going to fret a lot because you're going to run out of money. If your assets, your spending rate is less than 5%, you're in pretty good shape. By the way, if it's less than 5%, go check your math. I bet you might have forgotten a few dollars. Okay? But here's financial advice. I don't need a 72-page glossy brochure to get me to this page. How much do you spend? And if you're spending more than 7%, you have a problem. If you're spending more than 5%, you have an issue. Why? Because you're going to run out of money. This shows you the failure rate. So you have over 25 years, if you're spending 70%, you have a 50% chance or greater of running out of money by the time you leave this earth. I have another chart that shows the same thing. This is over 15 years. Look at asset allocation is important. You can see how that spending rate, given higher spending rates, how those monies pay down under different asset allocations. So I'm not saying asset allocation isn't important. It is. But it's, to paraphrase Bill Clinton, it's the spending, stupid. Okay? Know what your spending rate is. So those are the advisors and the financial planning issues. So now you've got a financial plan and you've got to put some of that money to work. There's lots of folks that would love to manage your money, all called different things. I came across this survey that showed of the $17 trillion that are managed on behalf of individuals in America, how are those different dollars managed? By what different advisors? Well, the broker-dealers control about 36% of that money. The retail banks selling CDs or money markets or mutual funds control about a quarter of it. RIAs control about 10%. The mutual fund companies themselves about 10%. Just gives you a flavor for the order of magnitude of the different folks out there managing money and how much money they manage. No wonder the different brokers manage so much money. I was reading in my Bank of America report yesterday. They just hired another 457 advisors at Merrill Lynch this quarter. There's a recession going on. They hired more advisors. One place you can get a good job these days. They now have 16,273 advisors at Merrill Lynch. What do you think those 16,000 advisors are doing? Well, their bogey is to come up with an average sales number of $854,000 a year. If you meet the sales bogeys, you stay. If you don't meet the sales numbers, you leave. And I'll talk a little bit more about some of the wirehouses going forward. So, some of the things I want to think about, I've already talked about financial planners. Obviously, I'm going to ask about experience and how many plans have you done, how many folks have you worked with who are like me, right? And how long have you been doing it? Clearly, down on the investment side, I can get some good product down here, but I'm not in the mutual fund world going to get much service. I've already talked about that. With the RIAs, there's two different flavors. Some who pick individual stocks and bonds for their clients and manage portfolios of stocks and bonds, and those who pick mutual funds or exchange-traded funds. Want to know the difference of their approach. Our approach is kind of old-fashioned. We pick individual good stocks and own high-quality bonds, put them together, and charge a very humble fee, which I'll talk about in a moment. Within the full-service brokers, you want to understand that within the full-service brokers, when I go to UBS, all their services are tiered. They make no bones about it, put on the marketing material. If you have, candidly, less than $1 million, don't come to us. Or we'll give you, you can talk to the receptionist. If you have $1 million to $5 million, we'll put you in with this kind of product, emphasis on product, and you'll get this advisor. If you have more than $10 million, you'll get this services, and you'll get a private wealth consultant. If you have over $20 million, then you'll get lots of attention. Look, everybody has tiered services. We at Seaward have tiered services as well. We have an account minimum of $1 million. It's just a simple reality. It doesn't sound snubby. Reality is any advisement firm has capacity and the number of clients that they can handle. It takes as much effort to work with $1 million client as a $10 million client. Just kind of the nature of our business. Having said that, when you go into an RIA firm, typically, 3 or 4 folks in our case 12 folks that do the RIA work. You're dealing with a single advisor. He or she may have clients with $1 million, may have $10 million, but we're not tiering out an advisor. RIAs I know of particularly don't tier out who you talk to based on the money that you have. So it's a play way of saying you tend to get a more experienced person in the RIA world than you would if you went into a brokerage house. But I'm sure you can find, like any generalization, I'm sure you can find exceptions to that. Beware of the products that are within all these different firms, because the question is, what are they going to sell you? What are you buying? Okay? So RIAs, I mentioned, either separate accounts or mutual funds. Within the full-service brokers, many of the brokers have what are called wrap programs, where they'll give you the best of the best. We'll take all these different managers, put them all together, so you have the management fees, right, of the underlying funds, and then we'll wrap, Merrill Lynch will wrap another fee around of that. All of a sudden, you kind of start compounding fees. Be aware of what the total operating expenses are of not only the underlying assets, but the brokers wrap around that fee to understand what your total operating expenses are. It's very, or if they're selling mutual funds, if brokers are selling mutual funds, they're able to receive fees from the mutual fund companies, often in the form of 12b1 fees. So you've got to play detective here a little bit and sort out what the fees are. So you got to ask your broker, what are my fund fees? What are my total operating expenses? Are you earning 12b1 fees? Look I'm not saying that they're doing this for free. You're going to pay them something. I just want you to know what the total expenses are. I met with a client who was coming over from a broker last summer when he became a client with me, and he said, yeah, but my broker's not charging a commission on my mutual fund. That is a technically correct answer. What the broker didn't say is, yes, but I am charging you a 12b1 fee, which is 1%. So 1% 12b1 fee, your fund was 1%, I'm charging you 2%. Well, I could buy the same darn mutual fund for 1%. It's just a different class that allows the mutual fund to pay the broker to distribute the product. Okay, everyone get that logic here? So the total operating expenses, what does it cost to manage $1 million? All right, well, we did a survey, the RIAs in Boston just 2 weeks ago, and I took $2 million. We went to, what, 15 advisors, Tom, in Boston area?
Top 50.
I'm sorry.
Top 50.
I say it correct. Top 50. And on a $2 million investment, assets under management, it was 97 basis points, so call it 1%. Okay? Many of the wrap programs or the broker programs will start at 1%. It's common to see 2% or higher. So just be aware of it. A lot of the RIAs who pick funds or ETFs will charge 1%, and then they'll use very cost-effective index funds or exchange-traded funds that still have some operating expense to them, maybe 20% or 20 basis points, 0.2%. So all in, they're 1.25%, 1.5%, somewhere around there. Again, the more assets you have with the advisor, you'll get break points. So using average numbers here is a little difficult, but circa 1% is a place to start to understand. Down here in the mutual fund companies, you can have mutual funds products that I want to go right to the fees, that have loads. You all know that. Again, you're looking at what the total operating expenses are. Be careful of funds that have backdoor expenses, surrender charges, that if you leave the fund early, you might get a fee for leaving the fund. You want to be aware of that. Within the insurance companies, where do I start with insurance companies? Know what your expenses are, know what you're buying. If you're owning a variable annuity in an insurance company, ask the question, do you know what a mortality and expense risk charge is? You should, you're paying it. Okay, it averages across the country 1.25% on top of the funds, right? In our business, we say the insurance products belong up in the asset protection business. Hey, I have kids at home. I have insurance. I have a home. I have insurance. I don't have anything against insurance to protect assets or protect my health care costs in the future. But I humbly draw the line between investing and using insurance products as my investment vehicle. Here's my recommendation to you. Oh, by the way, the surrender fee typically runs for 7 years. If you're going to buy a variable annuity or a fixed annuity or an annuity contract to provide you income in retirement, please get a second opinion. Splurge $1,000 and go to any financial advisor. Start with A, go to Z, I don't care. Pick one and get a second opinion. Because I challenge you to A, know what's in that fund, and B, what you're paying, and see how it really works. I've been making this argument for years. At Fidelity, they used to say I had to get a food tester because I bashed annuity companies so much. And they're right. The reality is, for instance, last summer I had a client come to me and said, my dad's looking at buying this annuity contract. Will you look at it? Because he can't understand it. It sounds too good to be true. Well, how does that law work? It sounds too good to be true, right? Check the math. So I spent, it's 82 pages, went through the whole prospectus. It took me forever to kind of figure out what I thought the annuity was going to do in retirement. But candidly, and I've read a million of these things, I wasn't sure. So I took it over to Ty Kreff, the head of annuity products, the head actuary at Ty Kreff, and he spent an afternoon figuring it out. Between the two of us, we kind of figured out how it worked, and we were able to point to the Achilles heel that said, product works great if you live over the age of 92. If you die before you're 92, it doesn't work. If the two of us couldn't figure it out, my challenge is, can you? And if you don't know what you're buying, especially an annuity contract that you're locking into for the rest of your life, why are you buying it? Please get a second opinion on any annuities, be it variable annuities, fixed annuities, or if you're buying, certainly if you're buying an annuity contract. So those are my observations on fees and some of the products. Typically, when you're working with an investment advisor, you go through this process of starting with investment policy, going, how does that feed to asset allocation, picking out the securities that work in that, given that asset allocation, and then this part of the communication is part of an ongoing process. So, for instance, I was meeting with an institutional client 2 days ago, and we always look at, here's the way the portfolio's invested today, and here's the investment guidelines that allows us to be X% equities versus stocks. Doesn't us allow to have diversification, too much diversification in emerging markets. It has parameters. Every institution I've ever worked with has an investment policy. Why? Because it lays out what the plan is and helps you stick with it. Well, all institutions who are pretty sophisticated investors have investment policies. Why don't you? I'm not talking about a 50-page document. Part of your financial plan is, how am I going to invest my assets? If I'm going to be, pick a number, half stocks, half bonds, why? And how often am I going to rebalance from that? So if stocks do really well, I sell stocks and buy bonds. Bonds have done really well, I sell some bonds and buy some stocks, right? And part of that whole policy, part of that is saying, what is my spending? So looking at that on a regular basis and saying, wow, stocks are down, my portfolio is down, my spending is going up. All of a sudden my spending rate is going up. It's part of the mechanics of going back and revisiting, are we sticking with the plan? By the way, how are we measuring that success? What benchmarks are we using? You can't measure it. How are you going to know if it's any good, right? How are you doing? I often hear investors say, I'm earning X, and I ask them a simple question, is that good or is that bad? You get that blank look. What's your benchmark that you're comparing your performance against? We can spend a whole day on picking stocks and bonds. Whether you're picking stocks and bonds, or whether you're picking funds, or whether you're picking ETFs, I think that's all great. And look, I make a living out of picking stocks and bonds and being measured by performance. But for all of us in retirement, it's not what's going to make our retirement comfortable is not whether we earn an extra 1% a year. It's, do we have the right allocation? Are we spending too much? Are we paying attention to our plan, and are we sticking to our plan? And part of that whole, part of making that happen is the ongoing communication between you, your spouse, your advisor, to make sure that everything we've laid out here is continued on in a disciplined manner. This is pretty straightforward framework. Anyone who's selling you products and services beyond this, they may be great, but they're tearing you away from the core of what's going to drive your financial health in retirement. So I would stick to, what are you spending? Do I have an allocation, allocation that reflects that spending rate in my situation? And then make sure you stick with some quality investments, and avoid the urge to be the star of the cocktail party with a hot fund, with a hot stock. If you want to talk about that, we can talk about that another day. But I'll share with you here's my don't chase the hot stock. Peter Lynch, when he used to give these talks and we used to follow him around, he's probably one of the best stock pickers I'd ever know, and I remember he'd say, in my whole career as an analyst and a portfolio manager, I've only seen 12 times where you see a stock, it's priced perfectly, the story's great, and you can back up the truck and buy tons of it. It doesn't happen often. 12 times in my career, I've seen that happen. And I lost money all 12 times. Okay? That's Peter Lynch doing. So, avoid there's no free lunch out there, folks. The stockbrokers are going to call in with these great ideas. I've been around the block enough times to know that if it sounds too good to be true, hang up. And B, the hot stories, if they were that easy for everyone to understand, the market's pretty efficient. It would have already corrected that stock price. Can you, as individuals, go buy some individual stocks and do well? Sure. Especially if you don't trade them. You stick through, you let the markets ebb and flow and make noises they do, and stick with good quality. And again, it goes back to my sticking with my plan. So I've covered a whole lot of ground, and hope I've given you some flavor of different things to consider while looking at advisors and whether or not you want to bring some help. In your brochure, I've put a couple articles in there. Do you need a financial advisor? Here's a piece from Wall Street Journal on how to choose one. Another piece on what is a registered investment advisor. Another piece I found on Motley Fool. That's another good website on how advisors get paid. This echoes some of the points I've made here today that you can read at your leisure. But I hope I give you some sense of understanding that not all advisors or people that call themselves advisors are the same. Beware of those who are selling product. You don't need product. If you want to buy product, go to Costco. You don't need product. You need good, competent advice. Come up with a good plan, and then don't change the plan. Stick with the plan, right? And I think you'll get through these choppy times reasonably well. With that, I'll open it up to questions. It's always dangerous to stand between a crowd and their lunch, but I think I probably have about 15 minutes for questions.
You mentioned you like the Kiplinger site. What would be your, say, top 3 sites for just general financial information if you want to be a knowledgeable investor? Yeah. Top 3 websites.
There's so many good ones. I tend to bounce around. I'm a little ADD when it comes to going to different sites. Kiplinger is a very good one. I think Yahoo Money is surprisingly good. Yahoo's Money is surprisingly good. I go there a lot. Fidelity has some good stuff. T. Rowe on some financial planning software has good stuff. Vanguard has tons of white papers and information on sites that I think is really competent. They're not, Vanguard is the most passive sales group I've ever known. They're not selling anything. I stole one of their slides. And I'll think of 5 more as soon as I sit here. But Google's an amazing thing.
Investopedia is a really good one.
Investopedia, thank you. Thanks, Kim. Investopedia, where I blatantly copyrighted with copyright violation, printed some of their articles as well. But typically, if I'm looking at an issue like this, whether it's financial or it's others, I Google it. I read 3 or 4. There's a lot of great information on the web. Not all of it's that confident, right? Thomas?
Yeah, the T. Rowe Price site that John mentioned has a very good retirement planning and financial projections of various asset classes depending on your spending rate. And it's a very dynamic site, so I would recommend T. Rowe Price.
T. Rowe Price. It's a mutual fund company. T.ROWE Price. If you Google T. Rowe Price, it will take you to their website. Other questions? Yes.
I believe that my quality it goes down, it goes up, it goes down. I would like to take a course to teach me how to read a balance sheet so that I know I'm buying quality.
The question is there something to be said for holding quality and buying it and letting the company kind of weather the good storms or the bad storms? I did not plant that question, but we tend to try to buy good quality. The definition of quality is relative too, right? One man junk bond fund might be, a good bond fund. How do you find out, and how do you read good, where do you take a course to read balance sheets? I don't know. I mean, half the analysts that I talk to on Wall Street don't know what a balance sheet is. They're just selling me the idea to buy the stock. And candidly, back to controversial again, I can't read Bank of America's balance sheet because half the assets that I want to worry about are off balance sheet. I don't have a great answer for a balance sheet risk assessment, or how to read a balance sheet, and how to take a course in that. I mean, I took a master's degree and spent 4 years of my life trying to do that stuff. I would hesitate to imply that there's some easy solution for that. I just think I'd be misleading in it.
Merrill Lynch used to have a little booklet that you could get from them, how to read a balance sheet, how to read financial statements. So if you called any brokerage firm and just said, do you have a simple brochure that can explain it? I bet somebody has it.
Sure, good point. I'm sure if you Google it, you'll come up with countless, and that maybe that's a place to start. My point is, back in my early days, I used to work for a public company where we did the financial reporting, put together the quarterly statements. I know how to move things around the statement that helps me get to the EPS that I need to get to, and still get it through the auditors. So, I'm not sure where that's going. Okay, other questions? Where else can I be controversial? Let me do a little feedback. Did this, you walked in trying to understand how to choose a financial advisor. Too general, too specific? Did I try to cover too much? Thoughts? Covered kind of the water. I mean, we're covering a lot of areas, but.
Well, I kind of disagree with your, that meeting slide. That to me, communication is important, but I guess you're suggesting communication can be done over the phone. You don't need to have that one-on-one. Is that fair?
I want to be in front of my clients once a year, face-to-face, as a minimum, all right? But I don't think I need to meet with them every 90 days, because the world just doesn't change all that often.
If you can call them once a month, or send an email once a month, or an update once a month.
I talk to many, some of them more often than others. The real issue is if their financial situation changes or something that can change the plan comes up. I want to talk to them. I send out a quarterly newsletter that says, here's what I'm thinking about in the world, and then here's what we're doing with some stocks and bonds and the portfolio that we've had subtracted. But, I want to be really clear. A financial plan that's well built, it just doesn't change in a quarter. I'm happy to talk about some of my boards, my for-profit boards, like I manage money for a bank, and they're required by banking law to look at the portfolio and review it every quarter. So we sit down with the board every quarter. We don't cover anything really all that new in any given quarter, but there's something to be said for over-communication. But I see the point, and I'm happy to say that if you have an advisor that you haven't heard from in a couple of years, I think we could all agree that you're not getting probably the attention that you want to deserve.
Don, you might stress the difference between an advisor and a manager?
Yeah, pretty broad category. So, I mean, part of the question is what's the difference between an advisor and a manager. Part of what I was trying to show between the different buckets, and there are some that will only give you advice, but won't actually manage the money for you. Okay, I may have glossed over that when I was going through that segmentation. And there are some that will manage money but not give you any advice, and there are those of us like to see that try to do both. Our thesis, this sounds self-serving, our thesis is those who are managing the money should know everything about the person for whom they're managing. So that's both advisor and manager. But I've seen plenty of good folks put together a good plan with a good advisor and then say, hey, let's execute this plan ourselves and buy some exchange traded funds or mutual funds. Am I missing something, a distinction that you think is important?
I think the distinction is for a manager, you turn the assets over to them and they have the discretion to invest.
I see your point. Not always, but yeah, so the point is who has discretion on buying and selling the assets. So many of the brokerage relationships, you, the individual, retain the discretion, and so the broker will call you up and say, hey, I think we should buy IBM today, and you have a veto, you get yay or nay power. I find that to be an interesting model. Because, if you're spending your time doing what you do in your life, how are you really adding value to the decision of whether or not the broker should buy IBM or not, or what the stock is? By the way, they're going to present the suggestion in a very positive light, right? They're not going to say, I think you should buy it, but here's 7 reasons why you shouldn't. Firms like ours, C-word, we have full discretionary authority. So we're buying and selling the stocks in your portfolio. Part of it's good reason to have the communication. Of course, from the custodian, you're getting a statement every month, seeing them. We talk about what we're buying and selling. But I'm hard-pressed to think of a client in the last decade that's called me up and said, why in the world did you buy XYZ company? I'm hard-pressed to think of it, even some of my day traders. Because if you have a philosophy of buying good companies, you explain to the company, the would-be client, here's a sample. I sit down and say, here's a sample portfolio of a client that I'm managing today. Here's the assets, here's the companies, here's the kind of stocks we buy, and here's what we're not going to buy. Companies that don't make money, the high flyers, the high PEs, the companies you've never heard of. There is no surprise when we're buying and selling stocks in the portfolio, but they are discretionary calls by the investment manager.
I think you should know where I'm coming from. I'm a retired registered investment advisor, certified financial planner. I don't think the handout makes it clear enough that many PEO and financial planners, most of the breed, are also registered investment advisors. And many of them do quite a good job at that. Having said that, I would also say that it was a very informative presentation. Really appreciate you really listening.
Yeah, appreciate it.
Talking about finances is not always behavior wrong.
Well, point well taken. In fact, I could parse some of the banks, because some of the banks have both RIAs and, we're to your point, for anyone you talk to, they may be an RIA, they may be an advisor, they may be affiliated with a broker. I hope I've given you the tools to at least flesh out some of the questions that you should be asking whatever advisor you go to make sure you understand, A, what it is they do, what are the services, what are the products they give you, and how much all of that's going to cost. So I hope I've given you a framework to ask those questions.
I'm interested in green investing. Do you got any advice?
The question is, in green investing, a common question that any advisor gets. The ability to build a green-only portfolio is pretty challenging, is my real answer to that. Many of the companies that would fall into a green screen, that you and I could agree with, are green-oriented. Many of them are younger companies, probably unseasoned companies, unseasoned products. Volatility and risk of those tends to be higher than what we bring into the portfolio. There are plenty of companies that can screen. We use some software to screen companies to see if they're environmentally friendly. We can screen some of that. But candidly, the way I would play the green element is I would pool it, and I'd have it be a part of my portfolio, and I'd say, all right, I could buy an exchange-traded fund or a mutual fund that specializes in that, and have it just be one of the part of my portfolio that I plug into it. If I could build a portfolio that was all green, but still had good quality, good balance sheets, good earnings growth, and good valuations, and wasn't like a cilantro that was going to risk going belly up without government financing, be happy to do so. I would caution you to say what's the quality of that portfolio. Also, too, a lot of those screens, I don't mean to go off on a tangent, a lot of times the screens that advisors use to screen out different stocks and bonds look at a company's just their U.S.-based operations, not their foreign-based. So they may be green or friendly or good to their employees here in the United States. The question is, what are they doing overseas? Oftentimes, that information isn't covered very well. I think I'm going to wrap it up here. I appreciate the opportunity to speak with all of you here today, and look forward to seeing all of you at lunch, where my colleague Tom Woodhouse is going to cover a very interesting topic, what we've learned here in these markets over the last 3 years. So,